Hello, everybody. Welcome to DuckerFrontier's webinar on the outlook for Europe, Middle East, and Africa in 2020 and what multinationals should be planning for. We are going to get started. We have quite a lot of colleagues on the line with you already. And thank you, everybody, for joining us today. We know your time is precious, especially during this time of crisis. In the meantime, if anybody is just out on the phone, there are materials that will be shared and quite a lot of charts and visuals. And so if you are able to join us through the GoToMeeting app, please do so because you will be able to see all the materials. And for any clients on the line, of course, you will be receiving these materials afterwards in case you wanted to use them or share them with other colleagues. Great. So as we get started, I would love to just let everybody know, in case you have any technical problems, please let us know by messaging DuckerFrontier webinars. Also, you might have questions. I'm sure that there will be quite a lot to discuss today. And so if you would like to ask a question of us at any point in time, please message using the GoToMeeting interface, DuckerFrontier webinars. We will collect those questions. We'll try to answer as many of them as we can. And for those that we don't get to, we will follow up afterwards by email. Before I get started, I would love to introduce you to the team that will be speaking today. My name is Martina Bozajiva, Managing Director and Head of Research at DuckerFrontier. I'll be joined by three of my colleagues, some of whom I think a number of you already know. Zeynep Kosserey-Sulu, who heads up our Middle East and Africa Turkey practice, Mark McNamee, our Director for Europe, with a lot of interesting insights to share, and Willem Atwell, who leads our Sub-Saharan Africa practice. So all three of them will share with you deep dives across the different regions and will be available to answer any questions throughout as well. For those of you who are new to us, I thought I should spend just a minute giving you a brief introduction to who DuckerFrontier is. We are a market intelligence and consulting firm that provides tailored solutions to drive growth for clients across the B2B, healthcare, consumer, and technology sectors. Our dedicated teams serve as advisors to clients, delivering the market and industry knowledge they need to succeed at all points in the business cycle. We do continuous research and insights, custom solutions. We offer transaction support services, and we also provide clients with timely, actionable insights to adapt and win in changing markets. And certainly, things are changing very quickly around us right now. The company is headquartered in Washington, D.C., and we also have offices in Troy, Michigan, in New York City, London, Paris, Berlin, Singapore, Shanghai, and Bangalore. And this webinar is coming to you today from our home offices out in London as well as in the US. So with that, I would love to walk you through the plan for our conversation in the next hour or so. First, we're going to talk a little bit about the Europe, Middle East, and Africa region in the global context. And then we'll dig a little bit deeper into some of the trends and insights across emerging EMEA in particular that we think are not really being covered enough in the media right now, and are things that executives should be putting into their plans and thinking through as the next stage of this crisis rolls over. And then third, we will go around the region with my colleagues, starting with Europe, both West Europe as well as East Europe and Russia, then moving on to Turkey and the Middle East region, and then finishing off with Sub-Saharan Africa. And we'll do our best to preserve a little bit of time for questions and answers at the end. Certainly a lot to discuss for us today. So starting with EMEA in the global context, first, good old days back in January, this is what the world was going to look like in 2020. Of course, we are no longer living in this world and it feels very far away. But last year, and this is where we're coming from really, we saw somewhat disappointing global growth across the region as well, where we were seeing slowdowns in manufacturing in particular, even though there was also quite a lot of opportunities still in the consumer sector. None of this is true anymore. We're in a brand new world, and we are in the middle of a very complex crisis that started in China with the manufacturing stoppages caused by the containment measures against COVID-19, continued as China went into lockdown with a hit to consumption there, and now has gone global as well. And so those crises combined have been causing a sharp reduction in global demand across a ton of different areas and segments and industries. And were also combined with a once-in-a-generation shock on oil prices, which was not necessarily caused just by COVID-19, but of course has been exacerbated by it and by the collapse in demand for energy that has come through it. So we really are in uncharted territory, a highly complex environment for businesses. This is an opportunity for companies to reset in a number of different ways, and we expect that it will be a very interesting world once this is behind us, both from an opportunity perspective as well as from an industry and segment perspective. But we'll get to that in a moment. Right now, we are, of course, in the middle of the crisis. And the crisis looks quite extreme. We're expecting recessions in basically across major global markets except for China. We expect that the US economy will be in recession this year, given the hit to services that is coming from containment measures. Of course, major emerging markets will be affected by this as well. And across EMEA, Europe will also drive recession. So really, we're looking at an across-the-board global contraction. This is a bit different, where historically we may have had crisis in one region, but not necessarily everywhere all at the same time. This time is different. Some companies we speak to are hoping that China can help to pull us all out of this funk, but given the scale of the global slowdown, the fact that China itself was affected, and also the fact that China has debt to GDP of above 300% already, the ability of China to create a massive global stimulus that would inflate the global economy and drive growth like it did during the global financial crisis is much, much lower. So we really should not be relying on China to save us this time around. It will provide an upside in terms of demand, but it will not be sufficient to really avoid some of the worst of where this crisis is headed. And really, for us, one of the big questions that we see multinationals struggling is the question of timing. I think a lot of companies already understand that there is going to be a hit to sales and performance. The real question is about the shape of a recovery and the timing of that recovery. Most of the companies that we speak to are assuming that the worst in the US and Europe, with countries in different timelines, but gradually will be more or less done by the end of Q2. And we will start to see a stabilization and a period of normalization during Q3, and seeing a little bit more of a recovery, not necessarily back to where we started, but more of what it feels like a recovery into Q4 this year. These timelines are also baked into our forecast. So the data and forecast I'll show you in a moment will be influenced by this set of assumptions. And we also acknowledge that if the timing looks different and containment measure length and nature looks different, then of course the numbers will look different as well. And so this is really the most critical question. And of course, there are a lot of things that we don't know. And that makes forecasting this for businesses as well from a planning perspective very challenging, because we're trying to deal with a virus whose properties we don't fully understand. We don't understand whether people are immune to it or not after they've had it. Is it affected by weather or not? And what does a herd immunity look like potentially with this? All of those questions are unclear, and there's no consensus on them, making this an environment in which companies are focused on managing the short term, and they're thinking about the long term, but putting that into numbers, putting that into timing is exceptionally hard. And to add to that question, from a timeline perspective, we also should be thinking carefully about the what the timeline looks like if this is not a Q2 peak and then recovery into Q3, Q4. So there are two different ways in this this could go. One is that it just takes longer. And so we see that the current containment measures do need to go into Q3, and so they're extended much further, and you're starting to see that normalization only in Q4. So you may be taking another quarter out. This will have very substantial impact, and certainly from an economic perspective would create more structural damage, given that governments may not be able to sustain stimulus for that long, and destruction in terms of businesses and jobs is also probably going to be stickier if you're taking this into a 6 months containment period, for example. The other one, which is also worth thinking through, is what happens if you have this stop and start dynamic where you maybe feel like you're past the peak, governments start to allow certain activity to start to return, and then you have secondary peaks. And a lot of people are watching China right now to see if this is a possibility, and if so, what does that look like? The stop and start dynamic is, some of that is probably definitely going to happen, meaning governments may be a little bit more cautious, as are likely to be consumers as well, before they fully resume back to normal activities. But if you are starting to see this dynamic where we reopen certain economies in June, and then by August you have to close things down again for another month or 2 months, this obviously extends the recovery into 2021, and also puts us into a new normal that is exceptionally difficult to handle, both from a planning and from an executional perspective for businesses. So if you're thinking about what kind of scenarios should I be building, because already I'm feeling a little uncertain about my base case, these are the types of inputs that you want to be plugging into those scenarios and really seeing what does that look like for your business. Of course, there is a really big question here about governments, and especially in these downside scenarios, the tension between preserving the health and safety of the population and the economic well-being of the population becomes more and more extreme. So right now you're seeing governments that are more heavily focused on protecting health, but they can only sustain that for so long. And so the longer this continues, the longer it takes us to defeat the virus, the more that dynamic between having that choice starts to become very, very challenging, especially for countries that either have not the resources or the economic structures to be able to outlast this. Right now, you might be seeing that governments are oscillating between the two. This will probably continue. The types of things that will determine how they think about those trade-offs would be, of course, the structure of the economy and the vulnerability of their population as a whole, their ability to actually get the funding that they need to protect the population from an economic perspective, the state and stability of their healthcare systems. And I think down the line, you'll also be seeing political pressure on governments and potentially even political instability coming from prolonged crisis from an economic perspective, or prolonged containment measures, or both. So those will be things that governments will be looking at to make decisions. It will be really hard to predict with absolute certainty what type of trade-offs different countries and frankly decision makers will do. But these are the types of factors that they're likely to be taking into account. And then we know that a lot of companies we speak to are also trying to monitor this environment, and they know they have to adapt very quickly. So they're looking at what are the leading indicators I should be monitoring for? What is the true nature of demand? What is the true nature of the business environment today? Because historic data no longer is useful in anticipating it. And also, what does a recovery look like? And how do I catch it early enough that when it starts to be happening, I can be ready to respond to that? And so this is where we see companies trying to monitor really fast-moving indicators, weekly or daily, ideally, if and where those are available. And so just a couple of suggestions here. Of course, first we want to be monitoring some of the fundamental factors, which is the nature of the spread of the virus. We do want to be monitoring government response, and I know a lot of businesses are putting in place tools to do so, but I would also suggest monitoring whether or not these government measures are actually being taken up. So some of these stimulus measures, some of these business protection, loan guarantees, etc., are people and businesses actually able to take advantage of them? Because that really tells you whether or not they are likely to protect businesses and consumers. Of course, you want to be monitoring both employment data as well as confidence and actual sales data across consumers, and similarly across businesses as well. And so all of these indicators, if and where available, are things that should be part of your normal planning process and normal monitoring process and activity. The other thing to highlight here is that a lot of the knock-on effects from this crisis land into the real estate market, especially commercial real estate, because so many of these are businesses that occupy physical space. And so you should be monitoring the real estate market, because that will back into banks, and then banks will have to be backstopped by governments. And so then the question will be, can they afford to do so? How much can they afford to do? And what kind of cost will that come with as it comes to the scale of what kind of rescue the governments might need to do. So these are all ideas in terms of government monitoring. Now, next, we'd love to ask you a question about your own planning. And you should be able to see this on your screen right now. Please just click on the answer that best represents your view. These will be aggregated and not shared with names or company names, but it will be a chance for us all to see what others on the phone are saying. And ultimately, we'd love to understand when you expect to start seeing the sales picking up. One of the things that we've been seeing is a real kind of day-to-day changing of business opinions and perspectives on this. And so it would be interesting to see the answers today and maybe a few weeks from now, whether or not companies still feel confident about the timeline assumptions that they're making. Okay, so it seems like a lot of the people on the phone are looking at Q3 as the beginning of the recovery. So along the lines of the timeline that I shared with you, and some are a little bit more pessimistic looking at Q4, maybe even 2021. I would say don't take too much comfort into this consensus. Because we're all working with the same information and that information is imperfect. And so as you're thinking about pressure testing your own assumptions, certainly would suggest looking at those two other scenarios as risks to your current expectations as well. So moving on, I'd love to also comment briefly on the outlook for oil prices, which is the second crisis that I mentioned earlier. We expect them to remain very low this year. Our average expectation for Brent is $43 a barrel, which probably feels optimistic to you all right now, where they are today at 22, 23. This is based on a few assumptions. One is we are probably at the very depths of destruction of demand right now. And we expect to see demand picking up during the summer, both because of economic growth starting to pick back up, as well as the seasonality in terms of demand being stronger during the summer. And we're also expecting that Saudi Arabia and Russia will at some point come back to the table and negotiate some production cuts. It's impossible to know the exact timing of this, but we expect that they're not looking to live in a world of $20 a barrel oil price for all of this year. And so those factors mean that we're expecting to see a pickup in prices in the second half of 2020. But on average, of course, we're looking at a much lower price for this year. The other thing that we get a lot of questions about is what are other companies thinking about and doing right now? First, they're protecting their people, and they are also putting efforts towards supporting their communities and have been incredibly creative in looking for ways to contribute to fighting the virus. We're seeing a lot of focus on identifying impact on targets and assumptions, and also finding those leading indicators to drive better decision making. CFOs and their teams seem to be super busy right now managing liquidity risk, which is starting to pop up. That will become more of a problem over time in the coming weeks and months. And we're also seeing supply chain disruptions now, not so much coming out of China, but coming out of Europe and the US. In addition to that, though, we see businesses really thinking about what does this mean for my opportunities for my competitors and customers? What are the opportunities I should be preparing my business for as this crisis unfolds? And we think that the world in 2020 will look very different from where it is today. We expect to see consolidation of customers, especially in the B2B space, lingering price sensitivity, but also substantial pickup and a sustained pickup in demand for online services. We are expecting to see that competitor landscapes will be redrawn, and so there will be opportunities there as well as risks across a number of different sectors. We expect that going into next year's planning cycle, a lot of companies will be taking a fresh look at the resilience of their supply chains, and no longer just as it relates to China, but from a more of a global perspective, and trying to take a fresh look at that. And we also expect that in 2020 or even earlier, you will be seeing the political ripple effects of this crisis starting to play out, both as it relates to regulation of businesses, but also more broadly in terms of political risk increasing across a number of geographies as a result of the trauma of this current crisis. If we break this down by industry, I won't go through in huge amount of detail, but just highlight a couple of things. In the B2B world, we expect to see demand for digital services and automation solutions increasing, especially as that helps to reduce the amount of human labor and human exposure. We also expect that we'll be seeing consolidation in customers, potentially driving more demand for key account management and roles that can really strengthen key customer relationships. We also expect that from smaller customers, flexible payment terms and flexible business models would be even more in demand as companies take a while to recover the confidence for making larger investments, upfront purchases, and longer-term commitments. In the consumer world, we know e-commerce is big right now, but we also think that some consumers will be disappointed by the experience as some e-commerce players fail to deliver high quality experience for customers because they're overwhelmed and they're just too small to manage that effectively. So in some cases, you'll be seeing a massive pickup, in others less so. We do think that this will ultimately also drive pressure for the marketing mix and the product mix to shift, and especially for marketing to be a little bit more focused on digital. And we're also expecting to see a little bit more pressures from a pricing perspective, because you will be seeing structurally higher unemployment going into next year across a number of places. And so consumers might be much more hesitant for a much longer period of time than the pure policy measures would indicate. So it may take time to persuade consumers to make bigger purchases, more expensive ones, or even to treat themselves if they feel uncertain about whether or not this crisis will recur. So this takes us back to that scenario of stop and start. You will be seeing much more sustained low customer confidence if you are seeing a scenario in which people don't know whether or not their problems will recur. And then in the healthcare space, we expect a range of different outcomes, anything from reprioritization of long-term healthcare reform agendas, where governments are taking a fresh look at how they're spending. We expect this will also come with greater price sensitivity, even as more funding is fueled into healthcare sectors. So the landscape from a healthcare policy point of view is also likely to be changing, both in the short term, but certainly in the medium to long term as well. So all that said, there's one more trend that I wanted to share with you before we go around the regions, and this is both the picture of the region as a whole and also some of the risk areas to monitor. We're expecting across the region to see a severe impact from the containment measures on growth across both developed and emerging markets. Normally, EMEA has the option of offsetting pressure on one part of the geography with another. This year is not the case. So you will be seeing across the board pressures in terms of growth and no real place to hide in terms of any major markets that might be driving more opportunity to try and compensate for the impact on the West European business or major emerging markets within EMEA. The other thing that we should be talking about and should be on the radar of executives is what happens to some of the emerging markets across the region that don't have the ability to sustain or even drive large stimulus measures, but have been affected by the crisis and also have implemented containment measures. This is where we start looking at exposure in terms of, can governments afford to increase spending? And as you can see with a select number of countries here, the public deficits across the region already can be quite large. Some governments are also highly indebted, and so borrowing even more to do massive stimulus measures is just not an option. And in some cases, that also is increasing risk on the banking sector. So there are a number of markets across emerging EMEA that are highly vulnerable to this environment, where their economies and populations will be under pressure and they will be very limited in what they can do. Or if they do increase spending substantially, then there will be repercussions. And we've already seen that reflected in capital outflows. In this case, you're seeing exchange rates responding to that and depreciating across the region. And it's also reflected in terms of borrowing costs. So while Germany at the bottom here gets paid to borrow and can spend billions of euros to shore up its economy, that is certainly not the case for the likes of Turkey or Kenya or Nigeria and some of the markets that may desperately need the additional borrowing in order to be able to infuse any kind of stimulus into their economies. So these would be markets at risk. And so as a result of that, you might either be seeing a very unsustainable increase in terms of their debt exposure, or essentially an inability to do much stimulus, which then tells you that the damage on their economies is likely to be more longer lasting. So those would be things to monitor. Of course, there are other ways to get funding. We have seen a number of countries asking the International Monetary Fund as well as other multilateral and bilateral lenders to provide them with support. And this list is probably bigger, but the IMF is being a little bit shady about exactly which countries have asked for support. And so you should expect to see headlines for more countries asking for different types of facilities in order to be able to both fund their now more expensive debt as well as any kind of stimulus measures that they're driving. So I would say across the emerging EMEA, there are a number of countries at risk that are not being covered too much in the media right now, but are also things that are ticking time bombs anywhere from 3 months to a year from now that we'll be looking at and talking about. And so that secondary risk into the portfolio of markets in the region is something that companies should be watching very carefully, and they should be making sure their business is protected as much as possible from some of the downside effects of it. So with this, I think it's worthwhile for us to go a little bit deeper and look at the individual regions and make sure that we understand those dynamics. So I'm going to pass it over first to my colleague, Mark McNamee, who is our director for Europe, to cover West as well as Central and Eastern Europe for us. Mark, over to you.
Great, thank you, Martina. Appreciate that. We will be covering in this section all of Europe, with focus, of course, on Western European markets. Those are absolutely more high profile in your portfolios, and then delving a bit deeper into Russia as well as some Central Europe markets and CIS. Before we get into that, though, so if we can look at the next slide here, I do want to ask a polling question. So similar to the conditions earlier for the last polling question, we're just curious as to what you're foreseeing in terms of top line revenue growth year on year. So what do you currently expect now out of Western Europe this year, so in 2020, compared to your 2019 top line growth? So do you expect approximately flat sales relative to the year before, contraction 5 to 10%, 11 to 20%, et cetera, et cetera? So please take a second and then we'll review the results together. Great. So to be perfectly honest, having spoken with a lot of clients and in touch with a number of managers with Western Europe specific portfolios, this is in line with what we've been hearing and seeing. And honestly, I'd say this is not as drastic as some of the worst stories we've seen and heard. So rather surprised to see actually, nearly 30% expecting flat growth or even some growth this year, but seeing only about a 5 to 10% contraction by another more than a third of companies is actually revealing. So seeing that consistency is actually, I think, a bit relieving to me, frankly, as I was expecting results to be a little bit worse, maybe at that 11% and beyond for a lot of companies. So that's considerable, of course, seeing about over 40% of companies expecting 11% growth, contraction or worse, but nonetheless, a lot of businesses not as affected as maybe I would have thought, to be honest. Great. So can we go to the next slide, please? So what I want to show here, the next, there we go, this slide, are the restrictions in place. So let's just sort of level set on where we are with things. In short, this has been a consistently updated slide of ours, is obviously these countries with these various restriction measures that you see on the left side have slowly increased. So we've seen over time, of course, for all these countries, sort of more yeses populating this chart and less no's over time. This is also organized farther to the right is Italy, which of course have taken the most strict measures compared to UK and Germany, which relatively speaking are still a bit more lax in terms of their social restrictions and government policies. That said, we do expect, frankly, to see UK, Germany, Spain starting to take gradually over time more strict measures to be put in place. Questionable for the people with UK specific portfolios. It could become questionable in the UK in particular may not be closing businesses down to the extent that we've seen, for example, in Italy or in France or Spain, or what we expect to happen in Spain based upon some leaks from the government. But nonetheless, this gives you an idea of where we're going. In terms of timing, again, just to quickly reiterate, we do expect this to last across these Western European markets, these restrictions, through mid-May at least. And then also importantly, we won't see a lifting of all of these restrictions consistently across the board simultaneously. So we will see certain countries taking off certain restrictions gradually over time. So in certain countries, maybe businesses will allow to sort of come back online a little bit sooner, whereas say closed borders, international travel, things of that nature may be more delayed into say June or July, depending upon the trajectory of the outbreak. So that's to sort of keep in mind in the background. Next slide here. So those are the restrictive measures. Now on sort of the more positive side, Western Europe, fortunately, of course, has the financial capacity and through the structures of the European Union, the ability to help moderate some of the depth of the economic downturn, which is generally speaking good news compared to most other markets around the world. Very broadly speaking, just to summarize quickly all of these countries here, we're seeing, of course, a considerable additional healthcare spending, and then also other measures like tax cuts, wage subsidies, credit support in various forms, through loan support, loan repayment, deferrals, and things of this nature. And also, this is just where we are today. More policies are likely to come. Just to point out very quickly a couple of points, UK and Germany, by definition, being sort of the largest and most financially capable countries in the region, have the capacity to be spending considerably more. And so we're actually seeing that coming to fruition, particularly in Germany, if you look at the size of the bailout fund at 500 billion euros at the moment, which again could be increased. So Germany is taking quite active measures to help moderate the economic downturn. That's about 4% of GDP in the case of Germany. UK also, there's indications that they're likely to start increasing some of their government measures, some of the support to the economy. And if you compare that on the other side to Italy doing what they can, but this really amounts to about 1.5% of the country's GDP. So just simply less capacity to help. And of course, Italy needs the most help of all the countries at the moment. So it just gives you an indication of where things are and where they can be going. In terms of then sectoral impact, so having looked at sort of the geographies, the sectoral impact here, what we're showing here in this chart is that obviously the sectoral breakdown in terms of sectors that will be hurt a bit more than others, but then also this has helped us set up our scenario thinking in terms of forecasts for the region. So when we look at the gross value added, so the contribution of these sectors to the overall economy, we've effectively cut off about 55% of economic growth in these months during these lockdowns that started in March through April and into May. Basically, about 45% of the economy will be up and running. Of course, this isn't evenly distributed. So we're seeing healthcare, of course, more resilient, so still adding considerable amount to the economy for obvious reasons. But then things like services sector, business services, retail sector as well. Obviously, manufacturing naturally being reduced considerably more than that for these 2+ months. As a result, then, of course, we're going to see considerable slowdown and actually a recession across the European Union. So if you look here at our scenario thinking, I won't go through all 4 scenarios, but the point is, if you look at the bottom here in the highlighted area, our base case expectation will be 2 full months of a lockdown of these countries, these quarantines that are in place, some stricter measures even coming into place. And then you can see across the Western European 6 primary countries, as well as a Eurozone weighted average, you can see our forecast for the region for 2020 now, as a result of the economies being at roughly 45% of capacity in these 2+ months, and assuming a gradual recovery that Martina described earlier. No terrible surprise. Again, Italy, of course, will sort of be facing the biggest downturn, and as a result, of course, of stricter measures taken earlier, the extent of the caseloads of the outbreak in the country. So, of course, that hurts the country much more in terms of domestic consumer spending, as well as the critical tourism sector in the country. And then Germany also, a lot of clients have been surprised at the severity of the downturn in Germany compared to the rest of the region, particularly in light of Germany's general economic resilience and financial capacity. Germany, though, unfortunately, including last year as well, has been hurt disproportionately because of its reliance on the manufacturing sector and specifically exports, not just within the European Union, but globally and very specifically to China. So Germany is actually disproportionately harmed by this downturn from the coronavirus shock and the drop in Chinese demand. And therefore, we're going to see Germany performing at quite weak levels as well compared to Italy. Next slide, please. So that said, as mentioned, the Eurozone economy will face, on a weighted average, will be facing a contraction this year in 2020. Again, these are current forecasts based upon what we know today with our expectations along the assumptions that we've just mentioned. I would also indicate that our bias is to the downside. So if we were to make further revisions as economic data comes in the coming weeks, most likely, if there is a revision, it would be towards further contraction across all of these markets. The point here is that, if you can stay on that previous slide, please, just quickly. I just want to finish a quick point here. It's a broad-based slowdown across all economic indicators, with the exception of government spending rising across all of the countries. As I mentioned, Germany and UK have more capacity, so we're seeing stronger spending there. But you can also see, in terms of exports, in terms of investment, Germany and Italy, for the reasons earlier mentioned, will also struggle a bit worse than some of the other countries, leading to a region-wide recession. Next slide, please. And therefore, you can see on a quarterly basis, all of the countries facing a considerable downturn in Q2. The important point here is that there's a general contraction across the region in Q2. We will see a gradual recovery. So not a V-shaped sharp recovery back to pre-crisis situations in Q3. However, a gradual recovery, revival of economic activity across Q3, and then more normalization in Q4, as Martina described. And you can see this here, the data representing that statistically, how we expect that rebound to go forward. And again, this is the base case assumption, and this is our hope that things do start to improve across Q3 and then into Q4. Next slide, please. And so with all of that said, having looked at Western Europe, the impact, of course, on Central and Eastern Europe will be quite considerable. So starting with Central Europe, will be hit, of course, by the severe downturn in Western European markets. No terrible surprise here, considering the high linkages between the manufacturing sectors within Western Europe and Central Europe, and the strong trade relationship, high import and exports across the region. Looking at growth rates, you can see we've revised all of the primary countries in the region down towards a recession. Poland being more resilient, a larger market, of course, a more sophisticated market, a little bit less reliant on exports than some other countries, a little bit more reliant on its own consumer spending internally. So it makes it a little bit more resilient. In terms of currencies, you can also see general depreciation across the board. We've also depreciated a bit our 2021 forecast as a result. This is against the US dollar, so considerable weakness against the dollar alongside all other global currencies, to be fair. But compared to the euro, which is not represented here, just quickly, we see a little bit less depreciation, as the euro is also functioning similar to the dollar, not to the same extent, as a bit of a safe haven currency. So we're seeing a little bit less depreciation for these currencies against the euro in particular, a little bit more against the dollar. Next slide, please. And then I'll take another 3 or 4 minutes because I know we need to get to some of the other regions here in this webinar. So I'll just stick with Russia very briefly here. Russia has actually come a little bit late to the game, under reporting of the outbreak, and then a little bit late measures, but is now taking quite strict and swift measures in terms of its sort of social distancing policies and restrictions on movement. So they've imposed a lockdown on Moscow, St. Petersburg, all the major cities, and also quite strict penalties for disobeying various decrees. On the other hand, the government is sort of aware of the economic downturn from this and has created an anti-crisis fund. That said, the fund to date is quite small. Expectations that this will be expanded considerably. This is a very small sum compared to overall GDP and compared to Western European markets, but they are trying to protect the economy to an extent. Those of you who are, of course, reliant on the major investments in the national projects, so Putin's May decrees, it's already been sort of said that most of these projects that have not been begun yet will be delayed for several months until this outbreak is under control and the economy is reviving again. So that'll take some time to go forward. But nonetheless, the budget itself, in terms of macroeconomic stability, the government is in a very strong position, as you can see here, running surpluses in 2018 and 2019 with surpluses planned for the next several years. So the government has capacity quite easily, even with low oil prices, to help sort of protect the economy from going into a very sharp recession compared to other markets. Next slide, please. And then, of course, we need to say a word about the oil price, just to quickly expand upon what Martina had mentioned earlier about the oil price, is that Russia, of course, initiated this oil price drop by abandoning the OPEC plus output cut deal, the goal being to try to bring prices lower to put US shale producers out of business. In short, the strategy, Russia likely miscalculated, and this is not a strong long-term strategy. Russia can withstand low energy prices for quite some time, and likely longer than Saudi Arabia. Russia has very strong macroeconomic fundamentals, a budget based upon $40 a barrel, energy revenues only at 35% of total public revenues, etc. So they're in a relatively good position, as you can see. Nonetheless, neither Saudi Arabia nor Russia can withstand or want to bear the burden of even sub-30 or even sub-40 oil prices for too long. In particular for Russia, this would cause, and it already has caused, significant depreciation of the ruble. That, of course, risks high inflation. That, of course, then risks higher interest rates, and then would undermine everything Putin has been trying to do for the last year in terms of jump-starting the economy through his stimulus program. So this really undermines his sort of political and economic goals for the country in his term, in this, well, at least alleged final term of his through the end of 2024. So we do expect that this will hit a certain point to bring both countries back to the negotiating table and try to prop up energy prices in the coming months. If you look at Russia's forecast revisions then as a result, I can say we're relatively optimistic, to be perfectly frank, for the ruble this year. So the average for the ruble for the entire year, of course, this is much stronger than current levels, will be roughly around 70. Of course, the ruble was relatively strong in January and February. We expect energy prices to start bouncing back in the second half of the year, alongside the Russian economy, the Chinese economy, the global economy. So all that strengthening the ruble progressively from its current level around 78 to 80 towards the end of the year, closer to 67, we'll say 66, 67 by the end of this year. In terms of just GDP, of course, we're seeing a considerable slowdown. Growth should have been over 2% this year, now slowing down quite considerably. Again, the bias is to the downside as we see more information come in and see the impact of this lockdown on Moscow and other major cities. But nonetheless, we're not seeing inflation necessarily escalate too high. We're seeing consumer spending potentially still growing this year, minimally, but still growing, and therefore keeping the economy afloat. And then finally, just to do a wraparound for the next slide here, when we're looking at CIS markets, just very briefly, the concern here relates to a number of countries, of course, but I would point out in particular Belarus and Ukraine should see contractions this year in growth. So we'll see a slowdown across the region, but Belarus and Ukraine's issues, of course, the coronavirus impact is tapping into already pre-existing domestic financial issues and political risks, which of course is pushing down their currencies further and depreciating investment even further. And then also I would say in terms of risk, pay very close attention to Azerbaijan and the MENAT, which could break its currency peg if we have oil prices too low for too long, and likewise Kazakhstan, where there's been a lot of currency pressure. The currency is extremely weak at the moment, and if we have, and this is despite central bank support to an extent. So if oil prices are too low for too long, again, this could cause considerable depreciation of the tenge further. With that, I want to pass it on to the next region so we can try to summarize this whistle-stop tour of the countries in EMEA.
Wonderful. Thank you very much, Mark. I'll pass it on to Zeynep, our head of Middle East and Africa Turkey region, who will get us started with Turkey.
Perfect. Hi, everyone. So when we look at Turkey, after a relatively difficult 2018 and 2019, the country was actually poised for a very gradual recovery this year, but it had also been, of course, eroding some of its fiscal and financial buffers. The foreign exchange reserves were declining. The fiscal room to be able to respond to shocks was already narrowing. Credibility of the central bank, predictability of economic policy had been coming under question. Indebtedness in the country was rising, and the purchasing power of consumers and margins of firms were eroding. So come 2020, Turkey is not in the best place to, unfortunately, weather this shock. That's why we need to be preparing not only for our base case, where we believe around Q2 we will see a relative containment, and gradually towards Q4 an uptick in economic recovery. But we do still need to expect two downsides: one where external demand drop is much weaker and actually or much stronger, and actually the exports take a much longer time to pick up, or a second downside scenario where Turkey lags, especially Europe, in terms of containment, so more of a domestic drop in the economy. But in the base case in the next slide, what we can expect to see is still a very volatile Turkish lira, unfortunately, very much vulnerable to emerging market sell-offs. There will be a rise in government spending. We have already seen that the initial stimulus package has already been expanded to help the private sector employees especially, but it's of course going to unfortunately not be sufficient to bolster the economy fully. We expect a halt in investments and negative consumption in the first half of the year, normalizing into the second half of the year. In the next slide, though, we can see that different aspects of the economy will recover at different times. What we would expect to see is very much based on the recovery in Europe, exports to move with that. Investments will be lagging the most, where we expect a minimal recovery in investments next year only, as a lot of firms are coming under further margin pressure on top of the previous years. And we would, of course, expect to see a government that is more indebted in 2021. So although we might see more normalization in spending next year, a much more price-sensitive government. And then for local consumption to recover earlier than, of course, tourism, as global travel is going to probably take longer for for recovery. But in Turkey, we need to watch two main risks. One, an FX crash. If the lira goes beyond 7 to the dollar, that's the first risk we want to be monitoring. It could dip the economy into further recession. But also in the medium to long term, as Martina was saying, pressure on banking sector must be very closely monitored because of the credit boom that the government is looking to provide to the private sector in this crisis moment. But overall, as we wrap up Turkey here, we do believe that there are strong fundamentals, a sophisticated local market with a substantial size that will continue to provide opportunities in the future, but there will be very much high volatility that we will need to be managing from a kind of short-term perspective. That's a very different story to the Middle East, North Africa, where we can move on to, where what we've seen is a double crisis, one of COVID-19 and the oil price crash really pressuring the region. Here, you would expect to see further downward revisions to Egypt and Morocco after especially seeing some of the developments in Europe in terms of more and more restrictions. But on top of these two crises, we also want to remember ongoing political uncertainty in Lebanon, Algeria, Israel, and also insecurity in Iraq, Iran, and even ongoing missile attacks actually into Saudi Arabia. All of these countries have different levels of buffer against the crisis that they're managing on top of these political risks as well. So in the next slide, we can see the comparison of at least the GCC markets here. Oman and Bahrain, of course, are the most exposed to this situation within the GCC region. They have higher levels of debt. They were expecting higher oil revenues. They were expecting to spend a bit more than others, as you can see here. Their pegs are much more difficult to manage. We do believe that the pegs will remain in place. Saudi and even international organizations would probably be ready to support the pegs to not undermine the rest of the pegs in the GCC region. Kuwait was already budgeting for flat or further cuts in spending, so you can expect that to continue, especially considering that the government has not really announced a big stimulus plan. Qatar was barely recovering from the blockade, but now, of course, growth potential is even more muted going into 2021. The blockade is not really a priority currently to be resolved, and of course, external demand is much weaker. Let's take a closer look at how in the next slide we expect, again, we want to make sure and emphasize to our audience here that we need to differentiate between different pace of recovery across different sectors. The key things to highlight here are that you can expect a rise in export volumes from Saudi right now, but the rest of the GCC will not benefit from the collapse of the OPEC production cut deal because of lower demand. On the government spending side, again, in the short term, we can see higher spending on certain health expenditures, but come 2021, a lot of these governments will be more indebted. For example, in Saudi, we're seeing efforts to increase the public debt ceiling from 30 to 50% of GDP. So a different government spending environment next year, also for investments. And again, we are expecting that local consumer spending to recover a bit more quickly than global tourism. In the next slide, we can see for Saudi Arabia that we have revised down our forecasts, and that actually is on top of the initial projects that Saudi Arabia had announced, where they were expecting a minus 2.7% cut to government spending. They have announced a further 5% cut to that. So you can expect a very consolidated spending environment outside of the crisis areas right now. We expect some investments may recover into the second half of the year, but that's going to be very minimal. And of course, on a consumption and investment perspective, the entertainment tourism industry boom that was supposed to boost growth this year is of course delayed into 2021. In the UAE, we are unfortunately near a very possible recession because this country is even more, of course, reliant on the external environment, on receiving FDI, foreign direct investment, on receiving exports or expats, receiving more tourists, and of course, global trade through re-exports through Dubai. So you can expect to see a much higher government spending to be able to support the economy here, but unfortunately, that's going to really help businesses on the cost side, not really generating a lot of demand. And we are seeing that Expo, unfortunately, is likely to be delayed for a year or so, which is probably good considering that they wouldn't have experienced the full benefits. Now, on to Egypt, we were expecting in the highest growing MENA market, again, we were expecting a recovery this year, very much derailed because of the drop in tourism revenues, drop in remittances coming from foreign laborers in GCC or Western Europe. The formal government COVID-related restrictions are not as bad as those you see in Europe, but there's still a hit to local consumer spending ability, plus investment, public sector investment financing is at risk. and of course, exports are taking a hit as well. And you've heard Martina mention in the beginning of an emerging markets currency sell-off continuing, and that risk is very much true for Egypt. We've seen that the central bank is recently managing or intervening in the currency a little bit, and a small black market emerging, less interest in government bonds as well. So very important to monitor this currency very closely. You can see a lot of reserves actually that can help in the short term. It really depends on the length of this kind of a pressure on all these emerging market currencies. On to the last country we'll do a spotlight on across MENA, Algeria. This country, unfortunately, was already experiencing political uncertainty, a year of protests, a decade of underinvestment in the oil sector, and having run out of its sovereign wealth fund, and also gradually depleting its foreign exchange reserves. So not the best position to be in to face this twin crisis. Consumption we were already expecting to be relatively weak. But on top of that, the government has announced a 25% cut to operating expenditures and a 50% cut to capex. So unfortunately, you can expect a muted growth in Algeria. And in the next slide, we can see that the currency here is also under pressure. We have been observing and living with a black market rate here for some time, but the drop in oil revenues will surely reduce the ability of the central bank to manage this float for much longer. So do monitor for ongoing depreciation of the official rate as well. So overall, unfortunately, for the MENA region, we were expecting a tentative recovery across 2020, but unfortunately, that's going to be delayed into 2021. And what we really need to look for next year is new priorities of these governments after having increased debt and after having learned some tough lessons this year. But also we'll need to evaluate the resilience level of our economies for any new small or big shocks that might come in 2021 as they use a lot of their buffer this year. So I will pass it on now to an even more exciting and volatile region, SSA, to my colleagues on that side.
Thank you very much, Zainab. Next, we'll have a quick view on Sub-Saharan Africa before we wrap up. This will be presented to you all by Willem Atwell, who leads our practice for that region. Will, really hoping for some good news here. And so if there's anything you can highlight in this gloomy outlook, certainly would love to hear that.
I'll try my best. So if we can move straight on to the first slide here. So this is a region, of course, that is no stranger to crises and volatility. When thinking about how a big crisis affects this region, it's important to remember many of these markets have continued to grow through wars, through droughts, through famines in previous years. So important to take that into consideration when interpreting some of these growth revisions. That said, a number of them are expected to take a hit. I'd highlight a couple. Certainly there are those that are particularly exposed and globally connected and open economies like South Africa. And then there are those that are experiencing the double whammy of this COVID-19 induced global slowdown and the commodity price slump. So Angola, a very good example there, in a deep recession, Nigeria barely growing as well. And then there are markets in the region which have very severe structural vulnerabilities, pre-existing structural vulnerability. So Zimbabwe, a very good example. It was already in recession in 2019, and we expect that deep recession to continue. Zambia, another good example of a market that is structurally very vulnerable due to its dependence on a single commodity. And now I suppose over to the right-hand side of the chart here, we see a number of East African markets which are really net beneficiaries in the bigger scheme of things when it comes to the commodity price downturn. So these markets are going to be benefiting from lower import bills for fuel, lower fuel prices. That's going to help certain industries, certain consumer segments. But of course, they're not immune from the global downturn either. Many markets like Kenya or Tanzania, which have important tourism sectors, certainly affected by the real slowdown in any global travel that's happening, and that's hitting their hospitality sectors. And of course, the slowdown in overall consumer spending in the US, Europe, China, affecting their exports too, mainly of agricultural commodities. So if we can move on, we'll take a look at the currencies outlook. SSA, no, not immune from the outflows we've seen from emerging markets recently. Markets that have free floating currencies like the South African rand, of course, very exposed to that. And South Africa was recently also hit by another sovereign rating downgrade to junk, which exacerbated those capital outflows, and of course, weaker sentiment. But many markets also affected, of course, by weaker export earnings. Angola, a good example there. And we would expect certainly quite deep devaluations for the Angolan kwanza. There are one or two markets I think important to point out from a foreign exchange availability perspective, so dollar availability. The authorities in Nigeria, we're expecting them to allow a certain amount of devaluation this year, but then really dig in their heels. And this is really for ideological reasons and also very real fears about what further devaluation could mean for the inflationary environment in that market. The Ethiopian currency as well, we expect the authorities to allow a certain amount of depreciation, but similarly dig in their heels. And in defending those pegs, these markets are really going to denude their foreign exchange reserves quite severely. And so businesses with operations there should really expect foreign exchange availability to worsen. And so payments problems are likely to be exacerbated there. So we can move on to the next slide here, really look at some of the measures that African governments are taking to try and contain the virus. Many of these are quite draconian, actually, and even by the standards of European markets, where certain businesses and industries have been closed, public transport restricted, and so on. Even by those standards, African governments, many of them are going beyond those restrictions, which may seem disproportionate, given that actually most of these markets only have a few dozen cases at the present time. And this is really out of fear for what would happen should the coronavirus infections really explode in this region. So these are health systems that are really not well positioned at all to cope with a major pandemic. We saw how markets in West Africa and in Central Africa struggled to contain the Ebola outbreak. And so this is, of course, on a much larger scale with a much more infectious disease. So governments taking a very hard line to begin with in the hope that they can contain some of the spread. So there are a number of restrictions that are being imposed at the moment. Many of them, of course, are quite familiar to European or US audiences, but many of them are really going to hamper intra-African trade as well. So we may see some supply chain issues, for instance, borders in East Africa where they are closed, and we may find product shortages in certain places. So far, we haven't seen any port closures or of that nature, but certainly difficulty flying in goods in some markets as well. As Martina explained at the beginning of this webinar, African markets really don't have much space to offer fiscal support. It's really the more developed markets, South Africa, Kenya, that are offering some tax relief and income support to lower income segments of the population, but really not really much firepower to be able to provide stimulus should there be a serious economic downturn. So many are now turning to the IMF and the World Bank to try and access some emergency funding to try and mitigate the impact on budgets. Now, in the last few minutes we have together, I wanted to provide a bit more of a deep dive on South Africa, which for those with SSA business is really the largest part of the portfolio here. And really here we can see a key summary of some of the major forecast revisions we've made and some of the drivers of that. Now, South Africa, of course, did have some structural weaknesses to begin with. Throughout 2019, the economy had really been hammered by a loss of confidence, certainly, but also real disruptions to economic activity due to very severe electricity outages, which really hampered the mining and manufacturing sectors and sent the economy into recession in certain quarters, so contractions in GDP. We don't expect any expansion in GDP overall through 2020. We expect the economy to essentially remain in recession, with the severity of that could deepen depending on how severe the government's response is and how long it lasts. Two, I suppose, bright spots in the consumption side. One is consumer spending, so with a bit of government support for income protection, we would still expect consumer spending just about to remain in positive territory, and government spending certainly likely to remain in expansionary territory, despite, of course, the downturn in terms of government revenue. So we expect the government to borrow its way out of this problem, and that's of course going to have knock-on implications for 2021, 2022, as it perhaps has to reclaim some of that funding through additional tax measures or cuts later down the line. So that's certainly something key to watch. Fantastic. So that's our very whistle-stop tour of SSA. Martina, I can hand it back to you to sum up.
Thank you very much, Will. And thanks everybody who's still with us. I know that we are now at time. I'll perhaps offer just a couple of closing words. One is we are on the verge of a brand new world in more ways than one across a lot of the markets in the region, both developed and emerging. And this is where your local teams will be playing a hugely important role in providing you with insights about the true local dynamics, which can diverge and also pose both opportunities and challenges. Definitely think about the scenarios and the risks, but also opportunities that are coming up from a timing perspective. And even where possible, look to invest, because we know that once the dust settles, once we're past this, there will be a lot of opportunities for businesses across the region. Thank you very much, everybody, for joining us. For any clients on the line, we'll be sharing the materials as a follow-up. We'll also be following up on any questions that we received and that we didn't get to answer. And I also appreciate that we covered a lot of countries in a really short amount of time. So if you would like a deep dive into an individual geography or maybe a country that we didn't cover today, please reach out to your client relationship director, and they'll be happy to set up a much more in-detail analysis and conversation for you and your teams. We hope you and your families, friends, and communities are staying healthy and safe, and we look forward to speaking with you again soon. Thank you very much, everyone.